House prices rise again, but the pace of growth is coming off the boil. Tech stocks do best in the 2023 financial year, while property companies do worst. And Twitter limits how many tweets you can see. It's Monday, the 3rd of July, 2023. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. Revved up for a new financial year.
Yeah, it's quite significant, isn't it? First one of the new financial year.
It is.
It feels like there should be kind of music or fireworks or something, and really it's just another show, isn't it?
What's interesting is that Australia gets very excited about June 30. Nowhere else in the world does. Well, probably there are some places, but like the US doesn't care about the June 30. It's end of financial year date is actually the end of the same as the calendar year. Japan, the financial year ends on, I think it's March 31. In the UK, the fiscal year ends on 5 April. Absolutely no idea why 5 April. So we're the ones that tend to get quite excited about June 30.
5th of April.
Yeah, 5th of April. I don't know why. So the new year starts on the 6th of April. The new financial year in the UK starts on the 6th of April.
I'm sure there is some logic behind that, and I'm sure someone will be able to kind of get in touch and let us know why that is. But you know what, Sean, usually I learn something during the show. It's very rare that I learn it during the first 20 seconds of the show. So we're off to a good start for the financial year. We'll put it that way. After the show, we've got a great chat coming up with one of our semi-regular guests. Always fantastic to hear Roger Montgomery from Montgomery Investment Management.
Yes, we talk about the last financial year in equities, but probably more important for many of us, what's going to happen in the next financial year. He even gives us an insight into a couple of stocks that he likes in particular.
Yeah, it's great when he names companies. It is a really interesting chat for investors. It's coming up a bit later on, but the main story this morning, Sean, house prices continue to rise, but the pace of growth has come off a touch, suggesting it may take a while for prices to reach their peaks of last year.
That's right. The prices of homes rose in every capital city in June, with the exception of Hobart, where prices fell 0.3%. Across capital cities, CoreLogic's home value index rose a touch over 1%, but that was below the 1.2% pace of May. Since finding a floor in February, the index is now up 3.4%. But it's about 6% below last year's highs back in April 2022. Leading the way, last month at least, was Sydney, where prices rose 1.7%, and then Brisbane, which was up 1.2%. Adelaide and Perth came in at 0.9%. Melbourne was at 0.7%. Darwin, 0.5%. And Canberra, 0.4%. Again, it's lack of available supply, with listings sharply lower and migration that are pushing prices higher. CoreLogic's research director Tim Lawless said rising interest rates and lower sentiment will likely weigh on the pace of price increases going forward.
What about outside the capital cities? Sean, have you got that data too?
Yes, so the regions also recorded a fourth consecutive month of increases, though at 0.5%, it's a fair bit below the capitals. Since February this year, the regional prices across the country are just 1.1% higher. In fact, regional Victoria, though, it's the only rest of state market where quarterly housing value trends, that's over the 3 months, are negative. Still struggling in regional Victoria.
Okay, so then in terms of the financial year, where did we end up?
Best performer over the fiscal year was Perth, where prices rose 2.5%. In fact, it's the only market to show positive growth, though Adelaide was flat. Worst was Hobart. Values fell nearly 13% over the financial year. Canberra and Brisbane came in at about negative 8 to 9%. Sydney and Melbourne prices fell that 5 to 6% level. The median value of a home in Sydney is now $1,073,924. In Melbourne, it's $762,537. So, Michael, the upshot from the CoreLogic figures is that the housing recovery is underway. Prices have grown for 4 months, but with the exception of Perth, house prices still have a long way to go before hitting new highs, and that may take some time given the impact of interest rates.
All right, so that's the housing market. That's obviously the biggest asset market in the country. What about the equity market? How did the ASX 200 finish the financial year?
Well, it actually finished the financial year with a whimper on Friday. But it's been a pretty good year all around. The S&P ASX 200 closed Friday up just a touch at 7,203 points, meaning it jumped 9.67% for the financial year. Its lows were around September last year and its highs in February. The market is currently about 5% below its February peak. Now, in terms of sectors, 2022-23 was definitely the year of the tech stocks, in large part thanks to Wall Street and artificial intelligence and all the excitement about that. The local tech sector index jumped 37% over the year. Pretty spectacular. WiseTech Global, a standout in that. Next, in terms of sectors, were the utilities companies. Think Origin and AGL Energy. They both had pretty good years. The material stocks also did well. That includes the lithium companies, the gold companies. Newcrest Mining, for example, had a very good year. So too Fortescue Metals and James Hardie Industries. At the other end of the spectrum was the Real Estate Investment Trust Subindex, which rose just 1.4% for the year. That ain't much if you're putting $100 in. You're not getting a lot back for your investment. You can mostly blame higher interest rates and people working from home for that. Consumer staple companies, think Woolies and Coles, healthcare stocks, they also underperformed. The big banks fall into this category as well, although Commonwealth Bank slightly outperformed the broader market over the year. National Australia Bank actually went backwards by about 4%. 12 months ago, that was the darling of the banking sector. Clearly not last financial year, Michael.
Sean, this next question is driven purely by self-interest because most of us hold equities in our super funds. Does this mean returns from our super funds should be better than the previous financial year? And I'm asking this because I checked my balance last week, and so it's very, very much front of mind for me at the moment.
Yes, well, it's a good question because most of us have equities within our super fund portfolios. Broadly, people should have done well from that. It seems that market watchers reckon the median growth fund will return around 8% for the year to June 30. The previous year, it actually lost about 3.3%. So a much better year for super funds this last financial year than the previous one.
Yeah, that's pretty good. All right, international markets, what's happening?
There was a big moment in international markets over the weekend, Michael. Apple, on June 30, US time, which was Saturday, Australian time, became the first company ever to close with a market valuation of more than $3 trillion US dollars. Now, given the Aussie dollar's trading around 66.6 US cents, that's about 4.5 trillion Aussie dollars. Pretty spectacular.
That is huge, isn't it?
It is amazing. Overall, in the first half of this year, we talked about June 30 not meaning anything to anyone else in the world except for us, but notwithstanding that, the first half of this year, Apple's share price is up 55%. And that's really helped push the NASDAQ, which is full of tech stocks, up 33% over the last 6 months. The broader-based S&P 500 is up 16%. The US markets have really been on a tear, and the size of Apple is just phenomenal.
Yeah, that is a great story. There is plenty going on. Big start to the show, Sean. We'll be back in a moment with the rest of the day's business news. Sean, opposition leader Peter Dutton has accused some of Australia's largest companies, including Wesfarmers, BHP and Rio Tinto, of lacking backbone over their support for an Indigenous voice to Parliament.
All three have donated $2 million each to the Yes 23 campaign, which held events around the country yesterday. Dutton said there are many people at the moment craving popularity and trying to appease those in the Twitter sphere. I wonder who he was talking about. Anyway, he said corporate Australia isn't paying due consideration to the views of their workforces and the community. He went on to say that there are a lot of CEOs and chairs who have very different conversations with him in private than what they say publicly because they're worried about ESG, environmental, social and governance issues, and remuneration packages. It's time they started to stand up for what's in the country's best interests, Dutton said.
It's interesting, isn't it, the accusation of a lack of backbone for taking a stance on it? Because I would have thought companies that were essentially, to use his words, lacking backbone, you'd keep your head down and not have an opinion and not enter the debate at all.
Yes, let's not go into this debate because it is political and we're apolitical. But it's an interesting line of attack, shall we say.
Yeah, it is, isn't it? And I suppose it starts to get into that position of kind of should companies have a political stance on issues? And we've seen that developing over a number of years now where more companies are willing to come out and have an opinion.
Same-sex marriage was the big one. And, of course, Qantas was a big part of that. And they really led the way in terms of the corporate voice, which the CEO, Alan Joyce, felt represented his workforce. So what Peter Dutton is talking about, I'm sure if you put that to Alan Joyce during the same-sex marriage debate, he would have said the corporate view was reflecting his employees' view.
Oh, there you go. Now, Sean, July 1 has obviously ticked over. Plenty of changes now in force. We've got energy prices are higher. There are increased childcare subsidies. The superannuation guarantee has ticked higher from 10.5% to 11%. Another one is that wealthy retirees must now take more money out of their retirement accounts following a temporary change in rules during COVID. And they're going to give the extra money to their kids and grandkids.
Yes, I'm hopeful, though I don't think my mother's wealthy, but leaving that aside. So pandemic measures introduced a halving of the drawdown rate. That's the minimum amount that retirees must take out of their superannuation every year. That lapsed on Saturday, the end of the financial year. Financial advisors say that a significant portion of their clients that they don't need the extra cash, and they plan to gift it or invest it back into their superannuation funds or term deposits. That's according to a story in the Financial Review. Now, the drawdown rate currently ranges from 2 to 7%, depending on the retiree's age, meaning it will rise from 4 to 14%. Withdrawals are compulsory to make sure people spend at least some of their super rather than using it as a tax avoidance or estate planning tool. Anyway, apparently, most people that are drawing down extra or being forced to draw down extra are going to give it away.
Sean, the lack of support outside of the NDIS for children with disabilities is, quote, undermining the sustainability of the scheme, with parents pressured to present the worst versions of themselves and their children to get funding. This is according to the interim report by the NDIS review.
NDIS Review co-chair and architect of the National Disability Insurance Scheme, Bruce Bonyhady, said the absence of services for disabled Australians outside the NDIS created a system that was deeply unfair, according to a report in The Australian. The review's interim report, handed down on Friday, also identifies a lack of workforce quality and problems with the culture of the National Disability Insurance Agency as key challenges to the $40 billion a year scheme. The interim report notes that the definition of reasonable and necessary supports, which the NDIS Act says the scheme must provide to participants, is unclear.
This next story is pretty confronting, actually, and a little bit surprising how blunt it appears. Young male lawyers hit a six-figure salary before they turn 25 far more often than female counterparts, and that pay gap then persists through the generations.
A survey of more than 12,000 lawyers in New South Wales, published on Friday, shows the gender pay gap exists in the legal field regardless of a solicitor's age, years of admission, or sector of employment. In the under 25 age bracket, 1 in 9 male respondents reported an income above $100,000 compared to 1 in 25 women. About 1 in 3 men lawyers hit the $250,000 income in their 40s compared to 1 in 4 women. Experience is not the determining factor, with a report noting men report earning more than women admitted in the same year in all sectors of practice. This is according to a report on AAP. There is some improvement. 10 years ago, there was a 15 percentage point difference in the share of male and women solicitors earning more than $150,000. That's narrowed to 9 points in the latest survey. The proportion of overseas-born solicitors now matches the New South Wales population, about 3 in 10, but Indigenous solicitors make up less than 1% of the workforce compared to 3.4% of the New South Wales population.
French police have been engaged in heavy clashes in Marseille as rioters continue to pillage and destroy urban areas across the country.
It's been going on for nearly 6 days now, triggered by the police shooting of a 17-year-old last Tuesday. The youth died. The incident was filmed and shown on social media, and one of the 2 motorcycle police who pulled him over is now under investigation for voluntary homicide. French President Emmanuel Macron has authorised for the riot police to intervene after he was heavily criticised for not getting a handle on the crisis, which has seen flashpoints in major cities, including Paris, Lyon and Marseille. Over the weekend, the Marseille City Library burned down amidst the worst riots in 18 years. More than 45,000 police have been deployed across the country to try and quell the protesters. Police have responded in force in Marseille, particularly with tear gas and rubber bullets against marauding waves of youngsters throwing petrol bombs, smashing windows of shops and cars and stealing goods.
Sean, Nike is busy selling down large stockpiles of sporting wear and has reported better than expected sales, though its profits are a touch disappointing.
Yeah, so global revenue rose 5% to $13.8 billion for the 3 months to the end of May. That is a lot of shoes. The group has been selling through excess merchandise with discounts. Now, that excess merchandise has weighed on margins previously. Inventories rose slightly in the quarter compared with the prior year period. Nike's announced a strong performance in the Greater China region, which is actually a really crucial growth market where the company appears to be regaining lost ground. Nike's shares are down 3% this year. Now, remember earlier on we're talking about how well Wall Street had done, up about 16%. Just goes to show that Nike has lost some fans out there.
Yeah, seems to. Now, last one, Sean. Twitter is imposing a temporary cap on the number of tweets that accounts can see each day. And this is a move that has sparked a fierce backlash from some users.
Yes. So how many tweets would you look at in a day?
Most days, none.
Yeah. So this limit probably won't hurt you so much. Certainly won't hurt me. But over the weekend, Elon Musk, the Twitter owner, tweeted that unverified users, so his big push is to get everyone verified, so unverified users will be able to view as many as 600 posts daily, while Twitter Blue subscribers, where there's a cost, can see 6,000 posts, 10 times as many. It's all about addressing extreme levels of data scraping and system manipulation. This is according to Musk. He later added the limits will be increased to 800 and 8,000 respectively, without actually specifying how long the limits will last. About 5 hours later, he came out and he said, well, we're going to increase it to 1,000 for unverified accounts and 10,000 for verified users. Following Musk's announcement on the limits, or the announcements on the limits more accurately, the site's trending topics was dominated by complaints, with users posting about Twitter down and RIP Twitter.
Elon Musk just keeps delivering, doesn't he?
He's good.
Yeah.
He's good. He's so consistently inconsistent. It is just a newsman's dream.
Indeed. Up next is the Fear and Greed Daily interview with Roger Montgomery from Montgomery Investment Management. This is a great one for investors, isn't it?
Sure, it's all about what happened last financial year and perhaps more importantly, what he thinks is going to happen in the next financial year, very much from an investor point of view.
Yes, coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au, and a very big episode of Fear and Greed the week ahead with our resident economist, Stephen Koukoulas.
That's right. Of course, we've got an interest rate decision from the Reserve Bank tomorrow, and Stephen's very keen to talk about that. Another great chat, lots of information. We've had a couple of quiet weeks on the economy and things are really starting to heat up again.
Yeah, and Stephen is getting excited. Plenty of good listening out there. Thank you very much, Sean.
Thank you, Michael.
It's Monday, the 3rd of July, 2023. Make sure you're following the podcast and join us online on LinkedIn, Instagram, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.